All right. So, we got to talk about this Nasdaq dip, right? Everybody's feeling it.
Oh, yeah, for sure.
And to help us kind of wrap our heads around what's going on, we're diving into this Motley Fool article from just yesterday.
Sounds good.
It's called Nasdaq Correction, the best Magnificent 7 stock to buy on the dip right now.
Catchy.
Yeah. So we're going to break down their analysis, see if we can pull out some useful nuggets for y'all.
Yeah.
Maybe even highlight an interesting opportunity.
Yeah, absolutely.
So first things first, the article says that the Nasdaq Composite is officially in correction territory, which means, what, a 10% drop from its recent high?
Yeah, at least 10%, yeah.
10% or more.
Yeah.
So, the question is, what happens next?
Right.
Like, is this just a temporary blip?
Right.
A chance to scoop up some good stocks on sale?
Yeah.
Or is this like the canary in the coal mine?
Yeah. Is this the beginning of something bigger?
Exactly.
Well, the article points out that over the past decade, we've actually had 6 Nasdaq corrections.
Oh, wow.
Which averages out to about 1 every 1.67 years. So they're not exactly uncommon.
That's good to know, I guess.
And historically, these corrections have often resolved fairly quickly.
Okay, so like a quick bounce back.
Yeah, exactly.
Okay. But the article also mentions some things that are making the current situation a little bit more uncertain. Specifically, these reciprocal tariffs on goods from Mexico and Canada that are going into full effect like next week.
Oh, right. April 2nd.
Yeah, April 2nd, 2025.
Yeah.
So can you explain what those are? Like, what are reciprocal tariffs and why are they potentially a problem?
Sure. So basically, reciprocal tariffs are like, when one country puts a tax on goods coming in from another country.
Right.
And then that other country says, well, fine, we're going to put a tax on your stuff too.
Okay. So it's like a tit for tat kind of thing.
Yeah, exactly. It's retaliation. So in this case, we're talking about the U.S., Mexico, and Canada all slapping tariffs on each other's goods.
And why is that bad? Besides obviously making things more expensive.
Well, it can really mess up supply chains,
Oh, right.
Businesses rely on being able to get the materials and products they need from different places. And when you start throwing up these trade barriers, it gets more complicated and expensive for everyone.
So it slows everything down.
Yeah, and that can lead to slower economic growth, which is not what you want during a market correction.
Right. Makes sense. So the article is suggesting that these tariffs could potentially make this downturn last longer, maybe even push us into a full-blown bear market?
Yeah, that's a possibility.
Which is a 20% drop?
Yeah, 20% or more. That's the bear territory.
So not fun. Okay, so given all this uncertainty, what's the game plan?
Well, the article stresses the importance of focusing on high-quality companies. The ones that are financially sound and well-positioned to weather a potential storm.
Okay, so not just buying anything that's on sale.
Right. You got to be picky.
Be selective.
Got it.
So they narrow their focus to the Magnificent 7.
Yeah, the big tech players.
And they say there's one company in particular that looks really good right now, Microsoft, ticker symbol MSFT. So Microsoft, everyone knows Microsoft, right?
Pretty much.
The second largest company in the world.
Yep.
Already a staple in a lot of portfolios. But the article says there's still a good reason to buy it now.
There is. They lay out a pretty compelling case.
Okay.
Right.
I'm intrigued. Let's hear it.
So first of all, Microsoft is financially incredibly strong.
Okay.
They have a ton of cash on hand, like $71.6 billion.
Wow, that's a lot of zeros.
Yeah, and that's way more than their debt, which is around $45 billion.
So they're not over-leveraged or anything?
Nope. They've got a nice cushion.
Yeah.
And on top of that, they generated $26 billion in free cash flow in just the first half of their fiscal year.
Free cash flow being what? Money left over after paying the bills?
Exactly. So they're making money hand over fist.
And that's largely thanks to their subscription businesses, right?
Right. Those high-margin recurring revenue streams.
Okay, so they're making a lot of money. They've got tons of cash. What else?
They also have a AAA credit rating.
AAA.
Yeah.
That's the best.
Right. It is the best. Only one other publicly traded company has that right now. And get this, it's even higher than the U.S. government's credit rating.
Wow. Okay, so basically as safe as it gets.
Pretty much.
All right, so we've established that Microsoft is like Fort Knox financially?
Yep, solid foundation.
But why is now a particularly good time to buy?
Well, the article points to 3 main catalysts. The first one they call potential performance reversion.
Okay, that sounds fancy. What does that mean in plain English?
Think of it like this. Microsoft has been a phenomenal performer overall, especially since Satya Nadella took over as CEO back in 2014.
Right.
But over the past year, their stock has actually lagged behind some of the other Magnificent Seven companies.
Really?
Yeah, in fact, it was down 8.2%, which is the only negative performer in that group.
Huh. That's surprising.
It is, but the article argues that this underperformance isn't because there's something wrong with Microsoft's business.
Okay, so what's the explanation then?
They say it's more likely just a temporary thing. You know, like a really good runner who stumbles a bit but is still in great shape.
Right, they'll probably catch up eventually.
Exactly. And Microsoft's underlying business is still very healthy. Their last earnings report showed 12% revenue growth and a 17% jump in operating profit.
So they're still growing and making more money.
Yeah, and their margins are expanding too.
So basically, the stock price doesn't seem to be reflecting how well the company's actually doing.
That's the idea.
Okay, so maybe it's just undervalued right now.
Potentially. The article says it's currently trading at a price-to-earnings ratio of around 31.5 times trailing earnings.
And how does that compare historically?
That's on the lower end of its 5-year range.
So it might be a good time to buy while it's relatively cheap.
That's one way to look at it.
Okay, that's catalyst number one. What's the second reason?
Microsoft's recent price increase.
Oh, yeah. They just hiked the price of Microsoft 365 for consumers, right?
They did by a pretty significant amount, actually, like 43%.
43%. That's a lot.
Yeah, the monthly subscription is now $9.99 and the annual is $99.99.
Up from, what was it, $6.99 a month?
And $69.99 a year.
That's a big jump.
Mm-hmm.
Especially since they hadn't raised prices in like 12 years.
Right. The article says they're justifying it by adding those new AI-powered CoPilot features.
Right, all the cool AI stuff everyone's talking about.
Exactly. So that's on the consumer side. But here's where it gets interesting.
Okay.
The article suggests that this consumer price hike could be a test run for potential price increases in their commercial Microsoft 365 products.
Oh, I see. So they're seeing how consumers react first.
Yeah, exactly. Because the consumer side is only about 3% of Microsoft's total revenue.
Okay, so not a huge impact if people start canceling.
Right. But the commercial side, that's a whole different ballgame.
How much is that?
That's a whopping 31% of their revenue.
Wow, so if they raise prices there even a little bit,
it could have a huge impact on their bottom line.
That makes sense. So they're kind of dipping their toes in the water with the consumer price hike.
Exactly, testing the waters.
Smart. All right, so that's catalyst number 2. What's the third one?
This one has to do with AI and the costs associated with it.
Okay, so AI is obviously a huge focus for Microsoft right now.
Absolutely. And it's not cheap. You need a ton of computing power to train and run these sophisticated AI models.
Right, all those servers and chips and stuff.
Yeah, and Microsoft has been spending a lot of money in this area. The article mentions that they reportedly bought like 485,000 of NVIDIA's Hopper GPUs last year.
Those are those high-end AI chips, right?
Yeah, the top of the line.
Yeah.
And to put that in perspective, that's more than double what Meta bought and 2.5 times what Amazon bought.
Wow, so they're really going all in on this.
They are, and they're not just buying chips either. They're also renting a lot of GPU capacity from these specialized cloud providers like CoreWeave.
CoreWeave, what's that?
It's like a newer cloud company that focuses specifically on providing high-performance computing for AI and other demanding workloads.
Huh. Interesting. So Microsoft is spending a ton of money on AI infrastructure, both buying and renting it.
Yeah, and the article explains that a big reason for this is that Microsoft's own custom AI chip program has been a little bit behind compared to some of their rivals. Like who?
Like Amazon. Amazon has been investing in their own custom silicon for years now.
So they're not as reliant on those expensive NVIDIA GPUs.
Right. They can use their own chips, which are presumably cheaper and maybe even better for their specific needs.
Makes sense. So where does Microsoft stand with their own chips?
Well, they introduced their Maia AI chips in late 2023.
Oh, yeah, I remember hearing about that.
And Satya Nadella has said that they expect to not be chip constrained by the middle of 2025.
What does that mean?
It means they're planning to ramp up production of their own chips and hopefully start using them more and more in their own data centers and stuff.
So potentially saving a lot of money in the process.
Exactly, because right now those NVIDIA GPUs are a major expense for them.
Right. So the thinking is, as their own chip program matures, they'll be able to reduce their reliance on those third-party chips and improve their margins.
Yeah, let's hope.
All right, so let's recap. The Motley Fool is basically saying that this Nasdaq dip is a good buying opportunity for Microsoft for 3 main reasons.
1, the stock has been underperforming recently, even though the business is still doing well.
Right.
2, they're likely to raise prices on their commercial Microsoft 365 products, which could significantly boost revenue.
Yep.
And 3, they have a huge opportunity to reduce their AI costs as their own custom chip program ramps up.
Exactly.
So all of that combined suggests that Microsoft could be a really good performer in 2025, even with all the economic uncertainty.
Yeah, and they emphasize that Microsoft has that AAA credit rating, so it's a pretty safe bet overall.
Okay, so for all of you listening out there, the takeaway is this. Despite the Nasdaq correction, Microsoft might be a good buy right now.
It's definitely worth considering, especially if you're looking for a high-quality company with strong growth potential and a solid track record.
But as always, you got to do your own research, right?
Absolutely. Don't just take our word for it. Think about your own investment goals, your risk tolerance, and make sure any investment you make aligns with your overall financial plan.
Good advice. And here's a final thought to chew on. Microsoft is pouring a lot of money into building up its AI infrastructure and developing its own custom chips.
Yeah.
How do you think that's going to play out in the long run? Like, how will this affect Microsoft's competitive position in the cloud computing market?
That's a good question.
And how will it impact their profitability compared to their rivals who are also investing heavily in AI?
Yeah, it'll be interesting to see how it all shakes out.
Definitely something to keep an eye on.
All right.
All right, that's it for our deep dive today. Thanks for tuning in.